Explain the implications of the efficient markets hypothesis on investment decisions by Eleanor Swords and Emma Sullivan. Within this presentation, we will be constructing an investment portfolio for a client seeking investment advice. We have carefully selected a recommended range of investments that share the goals of the client whilst ensuring the balance of minimal risks with maximum returns. The main aim of the investment portfolio is to assist the client in making the correct investment decision that will help them achieve their financial targets. The portfolio has a balanced suggestion in terms of risk management and offers recommendations for varied time horizons within each strategy.
The following goals are those that the client may wish to pursue and will be achievable with the correct investment decisions. These goals are managing and reducing risks, managing liquidity and maximising return. To achieve these client goals, we have chosen the recommended range of investments: real estate, bonds, stocks, cash and cash equivalents and gold.
The first investment type is real estate. So what is a real estate investment? Real estate investment is a way of getting return through purchasing properties, renting them out, value appreciation or reselling. Now, how can you invest in real estate? So you invest in real estate in a few different ways, whether it's directly purchasing and selling properties, flipping the properties by purchasing and renovating them so that you can sell them for more than what you've spent, or indirectly through trusts such as rights. The trust owns, operates and pays for real estates across a variation of areas, which allows you to earn income from real estate without having to actually personally buy, sell or manage any of it. Now, here is the real estate investment that we have recommended. It is an apartment flat worth £100,000 in the Anfield area of Liverpool, which is L4. It is worth £100,000, but you will make an initial investment of £20,000 with a rental return of £700, which is £8,400 yearly. £350 of that will go towards a mortgage repayment. You'll be taxed on an income tax of 40%. You'll have to pay insurance of £225 and maintenance costs of £600, which is going to be a total of £4,185. So taking this off what you earn yearly, you will then earn £4,215, which is your total return per year, which is a return on investment of 21.08%. Now here's the liquidity and growth of the real estate investment. Liquidity is low, so you can't sell or access capital quickly. To access the capital, you'd have to sell or refinance the property, which again is a lengthy process. In this time, the market could fluctuate and the selling price might change. And then depending on the demand in Anfield, this will affect the liquidity and how fast you are able to sell it. Now the growth in real estate is generally strong over time, and compared to other areas such as London, Liverpool's property market is rather affordable, given the opportunity for capital appreciation, which is predicted to rise between 2 to 5% in the next 10 years, which is a great opportunity for the company. Now here are the risks and return of the real estate investment. Now the risks of this investment is renting the property. You have to face the risk of having no tenants for different amounts of time, or having no payments or late payments, which may lead to you having to pay for the mortgage costs out of your personal finances. You also face the risk of having to pay for expensive damage and maintenance costs and possible changes in tax, laws, rental rules and regulations. And then for the return, the net annual return is £4,250 per year after tax, which is a return on investment of 21.8%, which does not factor in the potential appreciation of capital, which is a high yield for a low risk investment. Due to the increase of property prices in recent years, this has led to an increase in people renting properties, which is a great opportunity for the client. The market value of property may increase, so in the future you could sell the property for more than you've invested.
Our next investment is bonds. What are bonds? Bonds are when an investor lends money to a borrower, typically a company or the government or a client. The loans are borrowed over a specified time period and hold a fixed interest rate, which is usually paid twice a year. How to invest in bonds? Government, companies or clients can invest in bonds in many ways, such as individual bonds, bond mutual funds, treasury securities and more. The investor lends money to the issuer by agreeing to a principal, a coupon rate and the maturity date. We are investing in two different types of bonds, the first type being government bonds. We will be investing $12,500 with a 3% coupon rate. After the 5-year maturity, the total amount will be £14,375. After tax, this is £13,625 with a return of investment of 9%. Here is the liquidity, growth, risk and return of government bonds. They are quite liquid as investors can trade their bonds earlier than the maturity date, which is easier to do with well-known government bonds. However, there's not much growth. Although you earn interest, this is a fixed rate, therefore there is no increase in coupon income during maturity. The high tax rate of 40% means a decrease in the overall income. There's a low risk as they hold a very low credit risks as they are backed by the government, so in a stable country they are most likely risk-free. Due to inflation, the fixed coupon rate of £375 will decrease in value over the 5 years. They have steady returns, with the returns being 9% after tax, meaning the return is steady and safe but not high. The other type of bonds we will be investing in is corporate bonds. We will be investing $12,500 with a 5% coupon rate. After the 5-year maturity rate, the total amount will be $3,125. After tax, this is $1,875 without including the initial investment, with a return of investment of 15%. This is the risk and return, liquidity and growth of corporate bonds. There is a possibility of risks with corporate bonds as they often pose as a higher risk than government bonds due to the possibility that a company may be unsuccessful and fail due to issues out of payment. If Zara were to face issues such as bankruptcy or financial problems, you may not be paid back. There is a steady return as you earn 15% of your total investment over 5 years. If you have a stable income each year, you are gaining more in the long run than what you put in. However, corporate bonds aren't very liquid as they are less liquid than government bonds due to the difficulty in selling before maturity. The liquidity of the bonds may fluctuate as the market, interest rates and companies' financial success changes. There is also not much growth as there is no room for growth due to there being a fixed coupon rate of 5%. This bond focuses on stable income rather than growth.
Our next investment is stocks and shares. When you purchase a stock of a company, you are investing into a share of the company. You purchase stocks in a company that you think will grow in value, so that in the long run you will earn more than what you invest. If the company grows in value, you can sell your stock for a profit. By investing in stock, you then become a shareholder of the company. So what do I invest in? If your priority is liquidity, you are more likely to invest stocks into large companies that are already established. And if your priority is growth, then you are likely to invest into smaller stocks into companies. Our first investment of stock is into Apple. We will be investing £7,000 in total. Each share costs £160, so in total we will be investing 43.75 shares. Total return per year is £420 and after tax it is £252 with a return of investment of 6%. Apple have high liquidity and a high trading of stocks, making it easy for you to sell your shares at any time without a high price change. Apple have a well-known, reliable reputation with an established customer base, so are set for future growth. They have an average growth rate of 8 to 12% per year, which is high. The risks, so bonds are high risk investments, however the greater the risk, the greater the return. There's a high risk of market fluctuations, tech errors, supply chain risks and market competition and stock changes. The stocks have an annual return of £420 before tax with a rate of return of 6%. The potential for higher return if prices grow and you sell at maturity. Our next investment into stock is Tesla. We will be investing £7,000 into Tesla with per share costing £220, leaving us with 31.8 shares. There's no dividend, so there's an estimated growth of 40%. This will leave us after tax with a return of £1,681.44. Tesla stocks are highly liquid as they are highly traded stocks in the market with millions being traded all the time. Prices of stock can change quickly, so the timing of when you buy and sell is very important. The growth, so Tesla's growth has been averaging around 35 to 40% per year over the past 5 years and is set to for the next couple of years too. The risks, so Tesla has price changes due to regulations, market changes and public response to their owner Elon Musk. If they grow 40% in the next year, you will earn £2,802.40 before tax on top of your initial investment of £7,000. Due to no dividend payout, you will only earn through capital appreciation.
Our next investment type is cash and cash equivalents. What are cash and cash equivalents? Cash and cash equivalents can easily be turned into physical cash with little or no value lost, as well as earning interest. How to invest in these is by placing your cash into cash equivalent investments such as cash ISA or saving accounts. Our first investment into cash and cash equivalents will be cash ISA. We will be investing $15,000 with a tax-free interest of 4.25%. The overall interest earned will be £637.50, with a rate of investment being 4.25%. The other investment will be easy access savings, where we will be investing £15,000 with an interest of 4.5%. The interest earned after the 40% tax will be £270 with a rate of investment of 1.8%. For cash and cash equivalents, they are very liquid as investors use cash for liquidity and short-term needs as it's easily accessible and can be used for emergencies. However, there is minimal growth as there is no growth in price for cash and cash equivalents. An increase can only come from interest payments, for example, an increase of 4.25%. There's low risks as they are backed by the government. However, there is the risk of missing out on opportunity costs that you can get from earning more in stocks and investments or higher returns elsewhere. The low risk means that there is a limit on the return that they can make. Our final investment type is in gold. What is a gold investment? Gold is a physical asset that is seen as a safe investment due to its long-lasting value. However, in inflation, the interest of gold can increase. How to invest in gold? There are many ways to invest in gold, whether that be buying physical gold and storing it safely, buying gold mining stocks, or buying digital gold through apps. We will be investing $11,000 into gold, and with this you can buy 6.9 ounces for $1,500 each. The leftover money can be used for storage. You can earn £283.50 if there is a 3% inflation increase. Gold is tax-free and the rate of investment would be 3%. Gold is very liquid as it can be sold at any time and is globally recognised by buyers and dealers. However, buying gold may mean added fees such as storage and selling fees. There's minimal growth as there is no income generated from gold as there is no interest added on. However, gold prices can grow with inflation, meaning its value can increase. The risk is low due to gold having historically held its value, making it reliable for storage. However, storing gold in the wrong place may cause damage or theft. The return is low on gold due to there being no interest or dividends.
What is the efficient market hypothesis? According to the efficient market hypothesis, asset prices effectively reflect their value since they are quick to update in response to new information. Investors cannot outperform the market in an efficient market since the pricing already takes the information into account. It holds that attempts to profit more from the market are ultimately based on luck rather than skill. Here are the implications on investments according to the efficient market hypothesis. According to the hypothesis, all of our investments are semi-strong as it efficiently reflects the value of the investment according to the public knowledge. However, there is still room for error, including lag time of updating information and investors reacting quickly to this. Here is the conclusion of our investment portfolio, showing the risks, return of investment, internal rate of return, liquidity, the tax you'll be charged and the total return of investment after tax. It also shows the allocated percentage of our client's total investment of £100,000.
Here is our list of references. Thank you for listening.